Hey, we are back, and joining us now is Jordan Belfort, entrepreneur, speaker, and best-selling author. He's got a brand new book out called The Wolf of Investing, My Insider's Playbook for Making a Fortune on Wall Street. And Jordan, best known for, he was portrayed as by Leo DiCaprio on The Wolf of Wall Street. Jordan, welcome to the Brian Kilmeade Show.
Thank you. Nice to be here, Brian.
Hey, Jordan, before you started in finance in your career, I know with the movies can have to speed up everything. What did you know about business?
So I was like one of those, kids that was like a born entrepreneur. I was always starting a business since the age of 8, right? I had a paper route that I was shoveling driveways after snowstorms in New York. Then I was a magician doing kids' parties and then made a lot of money at 16 years old, started to sell ices on Jones Beach. So it was always starting businesses. So it was in my blood, not in my family's blood. All my parents were both CPAs. So I had a kind of numbers background. But the entrepreneurial side was something that just came from me organically.
And when did you say to yourself, I'd love to master the market?
So I had started a business in my early 20s in meat and seafood, and I built up this very large company and then just made every mistake that a young entrepreneur could make, overexpanded, was undercapitalized, you name it, I made the mistake, right? Went bankrupt at about 23, and that's when I had heard stories about people working on Wall Street that were making millions. This is back in the 80s. I'm like, no way, it seemed impossible. But long story short, I got myself a job there, and that was when I first was exposed to the stock market, about 23, 24 years old, and I was just blown away by it. I did not grow up really understanding that, how much wealth could be created and also all the dastardly deeds that happen on Wall Street. And I think the reason I wrote this book ultimately is, I saw my own family members getting killed in the market the last couple of years. And there's a very simple way to avoid that and to really take advantage of all the value that Wall Street does create, because Wall Street does create massive value. They do. But the problem is they also have this other side where they then, beat you up really badly and churn you and burn you and create bubbles. So the idea is, how do you really participate in the market so you can expose yourself to all the great things they do and not get caught up in the nonsense?
Now, some people listening to us right now go, I'm not in the market. That's not me. I'm not buying and trading stocks all day. But they are if they have a 401k, right? I mean, they are if they have mutual funds. They are if they have an investment account.
Right. So in the book, I strongly urge you not to be trading all day and buying and selling and investing in individual stocks. That is playing the sucker's game. That's, in fact, the darker side of Wall Street. Really, you watch CNBC or whatever, where they're trying to convince you that you should trade from one stock to the next, to crypto, into oil, into bonds. That is a dead-end game. And unless you're a professional investor at the highest level, and even then, you're probably not even going to get close to matching the performance of the S&P 500. So the far better, more elegant way to invest is to simply, there's a couple of different positions you want to own, but they're long-term positions, and you want to be reinvesting your dividends, adding on to these positions slowly over time. And by doing that, you get to extract all this massive value that's being created in the economy while protecting yourself against all the crap that Wall Street slings at you and trying to get you to trade short term and buy options or the next shiny object. So in the book, I lay out this it's a proven formula, right? It's the best and worst kept secret at the same time of how you make money on Wall Street. So I believe everybody should really be doing this. And you're right, because if you have a 401k, an investment account, there are stocks in there, but typically those are being managed by a fund, and then you're paying fees and expenses and performance bonuses, and you don't need to do that. You just don't need to.
So you're presenting a formula that you did not subscribe to that got you into a lot of trouble.
Absolutely. No, this is the opposite of when I was on Wall Street. I was in that wild game of churning, burning, almost public venture capital, right? And I would never, as an older and wiser man, I would never suggest that someone do that to make money. Now, if you want to speculate, to have fun, there's nothing wrong with that, right? And I speculate myself, but that's not investing. That's speculating. And when you speculate, you can't really count on making money. You'll probably lose more than you'll make if you don't lose everything. So, but it's okay to take 5% of your capital, have some fun. Maybe you'll get lucky. But when I'm talking about something very different, I'm talking about basically exposing yourself to all the best companies in America. And these are global companies, so you're really exposing yourself to the world economy, right? And you can do this in one simple trade right, and put it into an account, a certain type of account. There's tax-free accounts. So there's a couple of nuances here, but it's very simple. It's like a set and forget strategy. And this has been proven academically, historically, to be a far more lucrative way for someone to invest their money for the long term and not get caught up in like trying to time the market. You can't time the market. It's too difficult. And, you know, we live in a world where all the information on every company is available to everyone at the same time. So unless you have inside information, which is illegal, then you're not going to be able to beat the market. You're just not. Or if you have lightning fast computers like Goldman Sachs on the floor where you're front running people, right? But we don't have that either. So my advice to people in the book is to essentially you can expose yourself to all the massive value that's being created, because Wall Street does create massive value. The problem is on the other side, and then take it away. It's like a corrupt casino. So not only are the odds stacked against you, but the dice are loaded. So you really can't win. That's when you play for the short term. The way you sidestep all that is by going for the long term and exposing yourself to the biggest companies and then balancing out with another investment of bonds. So it just historically proven to work.
Jordan Belfort, our guest, the new book that he has is called The Wolf of Investing, My Insider's Playbook for Making a Fortune on Wall Street. So, Jordan, you wrote the book for a reason. You want people to get it. I understand that. But can you give us an idea of some of the companies you think we can rely on these days?
Yeah. So, again, here's something about human beings, right? By our nature, we're really bad stock pickers. So for me to say to you, like, oh, buy this company or buy that, Meta is great, or you have to love Tesla, right? I mean, honestly, they're great companies, but here's the thing: you cannot. It's very difficult to pick one company that's going to outperform the market. Because like if I say NVIDIA, which is artificial intelligence, well, guess what? That's already the hottest stock out there. It's gone 300%. So it might seem like a great investment intuitively, but it probably the best might be behind it. So the point is, how do you expose yourself to all the best companies at once? And the way you do that is through an index, meaning the S&P 500. So by buying all of the best companies at once in one simple trade, right, you're now exposed to everything. You don't have to play I'm going to figure which one is better, which one's going to fall from grace.
So buy it all.
Right? So, you buy it all. But here's the thing. Then you have S&P, the company itself, right, which is 30,000 employees. Their index committee is literally poring over every company document, every report, and they're replacing the index. So the 500 companies that are there today are not going to be the same 500 companies that are there in 90 days. There might be one or two that change. And over 10 years, many of them change. So what happens is by buying the index, you're getting exposure to, at any given moment, all the best companies that are out there in the world, right? They're paying dividends, and you want to reinvest those dividends. And then also by adding a little bit of money each month or each quarter, whenever you can. I'm talking it could be $50, $100, or hopefully more each month, right? You could start off with as little as $10,000 or even less and end up in millions waiting for you when you're ready to retire. And that's through the process of long-term compounding, dividend reinvestment, and adding a little bit each month to your portfolio. You're not going to do that by buying individual stocks. You're gonna get whipsawed more often than not. If you'll be right one time, but eventually you're gonna roll in snake eyes and it's over. So this is like the ultimate strategy, by the way, for the average individual, even the wealthiest individuals, right, that don't want to get caught up in the nonsense of trying to time the market and pick individual stocks.
But how much do you watch the macro economy? How much do you watch, what Larry Kudlow says about where it's heading, what the Fed did yesterday, what CEOs are saying to find out how much to put in? I mean, how much are you glued to this information?
I'm glued to the information because I'm interested in the economy for running my business and just being a generally well-informed individual. But I would never take one thing Larry Kudlow says and use it to influence my investment decisions. Why? Because I don't invest like that. And you shouldn't either. I really advise anyone not to try to sit there, I think we're going into a recession, so I'm going to reduce my stock portfolio. Don't do that. In other words, markets go up, markets go down, recessions happen, expansions happen. But if you look over the last 150 years, okay, if you just simply stay the course and don't buy and sell and don't keep triggering taxable events, you're going to end up making a ton of money because the U.S. economy over time expands. And you can say we have all these problems. We do. There's problems with lots of debt and interest rates. But you know what? We're the best bad option out there. And I've traveled all over the world. I've spoken all over the world, mentored people. And there's something about the United States. It's the work ethic, the entrepreneurship. I don't think we're going anywhere down. We can go down for a year or two, but I think over the long term, the trend will continue.
All right, interesting. Here's what David Solomon said of Goldman Sachs about the economy.
The economy here in the U.S. has certainly been incredibly resilient. You saw the GDP numbers yesterday, which obviously were very, very strong. And I do think there's a risk that the economy is a little bit more fragile as we head into 2024. We're watching that closely. Obviously, uncertainty around the world and geopolitical uncertainty can contribute to a sense of confidence or a lack of confidence that can slow economic activity. But for now, the U.S. economy has been relatively resilient, but I think we have to watch it very cautiously given everything that's going on in the world.
So your thoughts about his thoughts is similar to yours, right?
Well, I mean, I agree with him. The U.S. economy has been historically incredibly resilient. That doesn't mean we haven't had some bad times, right? Like after 2008, when the bubble burst in the tech bubble, the dot-com bubble in 99 or 2000, right? And then back in 87 when I first got into the stock market, and then back in the Great Depression. But here's what happens, and this is the mistake that people make. You know, bear markets, right, by their nature, when the markets go down, right? Number one, the stock market is a leading indicator. So you can't say, oh, well, the economy's going down and at the time I trade based on what's happening in the economy. They don't necessarily link up together. That's number one. Number two is that bear markets are usually pretty intense, but they're relatively short-lived. In other words, they don't last for 10, 15 years.
Gotcha.
Right? Even the great crash in 33, the market in 5 years had recovered all its losses if you include the dividends that we were being paid at the point. So what happens is this. You can try to, engineer a portfolio and be buying and selling and rebalancing and saying, I'm going to go into more tech heavy because the economy is good and oil because I think oil, at the end of the day, you're going to be wrong more than you're right because you cannot.
So don't do that. I understand. No, I understand. I hear you. So that's one thing I think is interesting. A lot of people are saying this unprecedented is this debt. What's unprecedented is the big push to get off the dollar. Do either one of those things rattle your cage, Jordan?
Listen, the dollar, no. Getting off the dollar does not rattle my cage. I don't think that's really a big risk over the short term. If you still look at the numbers, the U.S. dollar, and I travel all over the world, people love the dollar. They love the dollar, okay? Now, as far as our net debt, there's a major issue there, and honestly, I don't know anyone who knows how that's going to be resolved at some point, okay? But here's what I would say. Again, if you look at the size of the U.S. economy, and also the nature of the businesses, our way of forming business, entrepreneurship, right? How we create value here. I really believe, and again, history doesn't always repeat itself, but it's a pretty good indicator, okay, over very long periods of time, that if you look at the S&P, the stock market as a whole, there's a slow, steady march upwards over time. Okay? And that protects you against inflation, by the way. It's the only investment that beats inflation. So if you're in bonds, you need to be very careful. There are some bonds that they're called inflation protected securities, right? Where you can actually get higher rates when inflation is higher. But generally speaking, stocks, and I'm talking about a basket, the S&P, the best stocks out there are your best bet to protect yourself against inflation, and you don't need to hire an expert.
Gotcha. Jordan, real quick, on Sam Bankman-Fried, can you make sense of what this guy's looking at? Do you sense this guy's a traditional criminal to you?
Yeah, I think he's an arch criminal. But I think to me, he's like a Bernie Madoff type. Because people sent him money, and he just took their money. It's very, very, very strange. People listen, I made mistakes. I went to jail, but I never did is went into a client's account and took their money. Like we manipulated stocks. I smuggled money overseas. You saw all this in the movie, right? But what we never did is had people send us money and just, let's just dip into the account and just take that. That's our money now, right? So I don't see how he's not going to get sentenced to a very, very long time in jail. I hope he doesn't get life because I don't think anyone deserves that. For what he did. I think that would be excessive. But I would be very surprised if he didn't get, 20, 30 years. I'd be surprised.
Jordan Belfort, congratulations on your new book, The Wolf of Investing, My Insider's Guide to a Playbook for Making a Fortune on Wall Street Legally. Jordan, thanks so much.
Legally, right.
That's the key. All right. Back in a moment.